All right, class. So now we are looking at chapter 9, the cost of capital. So let's take a look at that. In this chapter, we're going to understand the concept of the cost of capital and the primary sources of capital that are available to firms. We're also going to determine the cost of long-term debt and explain why the after-tax cost of debt is the relevant cost of debt. And then we are going to determine the cost of preferred stock. We're also going to take a look at the calculated required return on a company's common stock and explain how that relates to retained earnings and the cost of new issues of that common stock. And then finally, we're going to calculate the WACC, or the weighted average cost of materials, and discuss different weighting schemes that we could use. So, what's the cost of capital? This represents the firm's cost of financing, and it's the minimum rate of return that a project has to earn to increase our firm's value. So, managers are using that cost of capital to discount an investment's future cash flows to decide if that investment is worth taking. It's used as a benchmark against which they can judge their performance on. And then to also value that entire company when the firm engages in mergers and acquisitions, which we will get about at the end of the semester. We'll get into mergers and acquisitions. So the basic concept of capital. This is the firm's long-term sources of financing, their debt and equity. Firms can raise capital by selling securities like common stock, preferred stock, and bonds to their investors and reinvest those profits back into the firm. With capital structure, this is a mix of debt and equity financing that the firm's going to employ. And then the WACC, the weighted average cost of capital. It's the average weighted cost of debt and equity financing, where that weight reflects the percentage rate that each type of financing is used by that firm. So here's a table of capital structures of well-known companies in 2020. So if we take an example here, Johnson & Johnson, their outstanding debt was $29 billion, which is 7%, and the equity was $386 billion, so that's 93%. They have a total capital of 415 if you add the two. So basically, to get that percentage rate, you're going to take the 29 and divide it by the 415 to figure out what that total is representing out of the total capital. Facebook, $6 billion in debt, so that's 1% of their capital. That's 586 billion. So that means the equity makes up 99% at 580 billion. So a firm is currently considering two investment opportunities. Two financial analysts are working independently of each other, so not together. They're evaluating those. So for investment A, the cost is 100,000. The life of that investment is 20 years, and our expected return is 7%. So the analyst studying this investment recalls that the company recently issued bonds paying a 6% rate of return. He reasons that the project earned 7% while the firm can issue debt at 6%. It must be worth doing, so he's going to recommend the company to take this investment. Investment B costs 100,000, so same cost as A. The life is also 20 years, but this expected return is 12%. So the analyst assigned to this investment knows that the firm has common stock outstanding and investors who hold the company stock, and they expect a 14% return on equity. So the analyst decides that the firm shouldn't undertake this investment because it only produces that 12% where the shareholders are expecting 14%. In this example, each analyst, though, is making a mistake by only focusing on one source of financing rather than the overall mix. So what if instead they use that combined cost of financing? So using that weighted average, by weighting the cost of each source, they're going to obtain that WACC, that weighted average cost of capital. So assuming that the firm is going to desire a 50-50 mix of debt and equity, ignoring taxes, the WACC is 10%, so 50% times 6% debt and 50% times 14% equity. With the average cost of financing, the firm should reject the first opportunity because 7% is less than 10% and accept the second opportunity because 12% is more than that 10%. So again, if we see here, by using that weighted average, we can see that even though the shareholders are expecting 14%, that weighted cost shows us that, yes, the second opportunity is actually the better opportunity because it's going to give us more return than our weighted average cost. So what are some of the sources of long-term capital? They derive from four basic sources: long-term debt, preferred stock, common stock, and retained earnings. And not every firm are going to use all of these financing sources. So in our balance sheet, we have assets on the left side, and on the right side, we have our current liabilities, our long-term debt, our stockholders' equity. And these long-term debt and stockholders' equity section make up our sources of that long-term capital. So before tax cost of long-term debt. So that's associated with new funds raised through long-term borrowing. We have net proceeds, which are funds actually received by the firm from a sale of a security, and flotation costs. Those are the total costs of issuing and selling a security with two components: underwriting costs and administrative costs. Here's an example. Duchess Corporation, a major hardware manufacturer, plans to sell $10 million worth of 20-year 6% bonds, each with a par value of $1,000. Because those bonds with similar risk earn returns equal to 6%, Duchess's bonds are going to sell at the par value, so they'll have a yield to maturity equal to the coupon rate of 6%. But they will have flotation costs equal to 2% of the par value. So remember, the par value was 1,000. So we take 2% of that, and that's going to be $20. So the net proceeds to the firm from the sale of each bond are going to be 1,000 minus those flotation costs of 20. So the net proceeds are $980. When we talk about before tax costs of debt, it's the rate of return the firm has to pay on that new borrowing. So that's going to be indicated by RD. We can use market quotations. So this is a simple way to estimate a firm's before cost of debt, before tax cost of debt. That it's going to go to a financial website and look up the YTM, the yield to maturity, on existing bonds or maybe similar risk bonds issued by other companies. They can also calculate the cost directly. So rather than using that yield to maturity on other bonds to estimate the costs, they're going to possibly do their own YTM calculation to calculate the cost of a new bond issue directly. So here's an example. Beforehand, we looked at Duchess, who receives those net proceeds of $980 by issuing those 20-year bonds with $1,000 par value and that 6% coupon rate. So to calculate the before cost of debt, begin by writing down the cash flows associated with the bond. So the cash flow pattern consists of an initial inflow, those net proceeds, followed by a series of annual outflows, those interest payments. So in the final year, when the debt's retired, the outflow is going to represent the repayment of the principal. So here are the cash flows. So end of year 0, we have a cash flow of $980, right? Those are our net proceeds from the initial sale. In years 1 through 20, we are paying out $60. Remember, 1,000 times 6%. That's the interest rate that we're paying out. And then in year 20, we're repaying that $1,000. So the before tax costs associated with this bond issue is the YTM, which is the discount rate that equates the present value of the bond's coupon and principal payments to the initial net proceeds. So we can use our calculator to calculate this. Again, we're looking for the interest rate here. So we can see by plugging everything in, our yield to maturity equals 6.177%. And then we could also use Excel, which is going to give us the same exact answer. So again, our par value is negative 1,000. Coupon rate is 6%. One payment a year. That payment is worth $60. So that's a negative outflow from us. The years to maturity is that 20-year bond. The net proceeds is $980. So our before tax cost of debt in B8 is going to equal the rate, because we want to find out what that rate is, of B6 times B4, which is the years to maturity times the interest payments a year. And then you're going to put a comma and then use B5, which is our interest payment of $60, and then comma B7, which are our net proceeds, B2, which is our par value, and then 0, again, that's with the annuities. So we're not looking to do anything with annuities. So the minus sign has to appear before the 1,000 in B2 and the 60 in B5, because those are outflows for us. after-tax cost of debt. So unlike dividends on stock, interest payments on bonds are tax deductible. So the interest expense on debt reduces taxable income as long as our interest doesn't exceed 30% of our EBIT. And therefore, the firm's tax liability is going to be this equation 9.1. So again, there's that RD, that's that before tax cost, times, and then we're going to take the 1 minus the tax rate, or T. So let's use this in an example. Duchess pays 21% tax rate, right? They're a corporation. So using the 6.177% of before tax debt cost calculated above, we can use that in this equation to find their after-tax cost of debt. So again, that's the 6.177 times 1 minus 0.21, and we get 4.88%. So if their interest rate reaches, or their interest expense reaches 30% of their EBIT, then additional interest expense is not tax deductible. And for any additional borrowing, the before and after tax costs of that debt is equal. So recall that when bondholders purchase Duchess bond at par value, they're going to expect that 6% YTM, right? So incorporating the issuance cost and the tax benefit of debt, the firm's after-tax cost is just 4.88%. So that's quite a bit less than the 6% offered to the bondholders. For two main reasons, debt is usually the least expensive form of financing to a firm. It's less risky than preferred or common stock, and investors are going to accept lower returns on bonds than on stock. And the firm enjoys that tax benefit of issuing debt that it doesn't receive when it issues equity capital or uses equity capital. So let's look at a personal finance example. Kate and Cassim Sullivan, they're a married couple in the 28% income tax bracket. They want to borrow $60,000 to pay for improvements to their home loan. So to finance the purchase, either they can borrow from a relative at an annual interest rate of 4.5%, or they can take a second mortgage on their home, which is a home equity line. The best annual rate they can get on the second mortgage is 5.5%. If they borrow from the relative, the interest will not be deductible for federal tax purposes. But if they borrow from the bank using that second mortgage, it will be deductible because the law allows individuals to deduct home mortgage interest. So let's choose the least cost financing. So let's calculate the after-tax cost of both loans. Because interest on the loan from a relative is not deductible, their after-tax cost equals the before-tax cost at 4.5%. We're going to use that equation from 9.1 to show that the after-tax cost of the second mortgage is actually 3.96. So the Sullivans should use the second mortgage to finance the home improvement project. And again, it's because they are from a bank. It's a home mortgage. It's considered a mortgage. It's not a gift or a loan from a relative. So that's one way to circumvent using that to depreciate and deduct from your taxes. But it doesn't imply that they should always finance investments with debt for firms, right? Because financing with debt puts their existing shareholders in a riskier position because they have to repay their lenders regardless whether they're profitable or not. And existing shareholders are going to demand a higher return, which is going to raise their cost of equity. The increase in that cost of equity could partially or fully offset the benefit of those low-cost debt as a financing source. So the firms really have to weigh the trade-offs when using different sources of capital. Now let's look at the cost of preferred stock. These preferred stock dividends are the shares that usually pay a dividend. They're fixed. They have a fixed par value. And we can calculate this using the ratio of the preferred stock dividend to the firm's net proceeds from the sale of a preferred stock. So that's our RP, which is our cost of preferred stock, is equal to the annual dollar dividend, or DP, divided by the net proceeds from the sale of stock, or NP. Preferred stock is it's a dying security. Of the 50 largest firms in the U.S., only banks like JP Morgan, Bank of America, they raise money through that preferred stock. Banks usually use those preferred shares to meet regulatory minimum capital requirements without diluting their common stock ownership. A lot of companies don't use preferred stock because it has a lot of disadvantages of debt, like fixed dividend payments that resemble interest payments on bonds. But it doesn't enjoy those main advantages like that tax deductibility. So let's look at an example again for Duchess. They're contemplating issuing 8% preferred stock that they expect to sell at par value for $80 per share. The cost of issuing and selling this stock will be $2.50 a share. So the first step is that we have to calculate the dollar amount of the annual preferred dividend. So that's going to be the 8% times our $80, right? So it's going to be $6.40 for the annual preferred dividend. Then the net proceeds per share have to come out. So $80 minus that $2.50, that's our cost. So our net proceeds are $77.50. So let's take that equation that we looked at in 9.2 and substitute in. So we have 640 divided by 77.50. So we're going to get a cost of preferred stock of 8.258%. We could also look at the cost of common stock. So what is that? Those are costs associated with using common stock equity financing, right? That's equal to the required return on the firm's common stock in absence, which means they're not there. Those flotation costs don't come into play. So it's the same as the cost of retained earnings, but the cost of issuing new common equity is usually higher. So let's look at the constant gross valuation model again. That's that Gordon growth model. So this is our equation 9.3, where our current value of common stock, or P0, is equal to our dividend expected in year one, or in 1 year, divided by our return on common stock minus that constant growth rate, right? We could look at this equation here, where we're going to solve for RS. That'll give us that common stock cost. So the first term captures the return that shareholders expect to earn from dividends, and the second term captures the return that they expect to earn from their capital gains. So let's go back to Duchess. Again, the market price here, P0, is $50 per share. They recently paid a $3.80 dividend. So they increased their dividend for several consecutive years. Just 5 years ago, they paid a dividend of $2.98 on the common stock. So let's use a calculator, right? So we can put this into the calculator and we can find out where our growth rate is, which is the rate that we're looking for here, by substituting in N is equal to 5. The present value was 298. The future value was 380. So what's that growth percent, right? So it comes out to be 4.98, or close to 5%. If they continue to increase the dividend at that rate, then the next year's dividend will be 5% more than that $3.80 dividend that they just paid, or $3.99. So let's use equation 9.4 to figure out what that return is for our common stock. So we have $3.99 divided by $50 plus 0.05, because that's our growth rate, right? So we get 12.98% total. So because that estimate depends on an imprecise forecast and the long run dividend growth rate, a kind of false prediction or precision arises, saying that the required return is about 12.98, or 13%. But we can also find the cost of that common stock equity, right? We can use the CAPM model, the capital asset pricing model. This describes that relationship between the required or expected return on some sort of asset and the non-diversifiable risk of the firm captured by that beta coefficient. So again, this equation here is 9.5. That's the CAPM model, where the RJ is expected return on that asset. RF is that risk-free rate, beta coefficient for asset J, and then the RM is the expected market return in this equation here. So again, let's go back to Duchess. They want to use the equation that we just looked at to calculate the required return on its common stock. So again, we have a risk-free rate. It's equal to 3%. The beta equals 1.5, and the market return is equal to 9%. So let's substitute those values in. We can see here that the company is going to estimate that required return on its common stock to be 12% then. So that estimate doesn't line up with the estimate that we looked at in the constant growth model, right? That is because the two models rely on different assumptions. So they might average those two figures to arrive at a final estimate for the required return. So if we're looking at 12% here and 13% there, they might settle on 12.5% then. When we compare these two techniques, we look at the CAPM technique. It differs from the growth model the constant growth valuation model because it considers the firm's risk that's reflected in the beta in determining the required return. And the constant growth model doesn't look at risk directly. It's usually an indirect approach to infer what those shareholders are expecting based on what they paid for the stock today, given estimates of those dividends in the future. There are flotation costs that increase the cost of capital to the firm, and the cost of new issue common stock is RN. So it's net the underpricing and associated flotation costs. So that's equation 9.6 here. So RN is our cost of new issue, is D1 divided by N plus G. So again, that G is that constant growth, right? So D's are our dividends and the N is our net proceeds. So if we look at this an example, again, we're going to look at Duchess. So the RS we're going to use is 13% from the initial, right? Using that constant growth valuation example. So we have D1 is $3.99, current price is $50, and expected growth is 5%. So to determine that, we're going to estimate our new shares are going to sell for $48. So they're going to be underpriced by $2 a share. A second cost associated with a new issue is those flotation costs, and those are at $1.50 a share. So that would be paid to issue and sell the new shares. So the underpricing and flotation costs are now $3.50. So you add the underpricing plus the flotation cost, so the $2 plus the $1.50. So let's take a look at that into our new equation here to figure out what our cost of new common stock is, right? So $3.99 divided by the net proceeds of $46.50 plus the growth rate of 5%, we're going to see that the cost of our new common stock is between 13 and 14% at 13.58%. Now we can look at our cost of retained earnings, right? Our R. This is used as a financing source. It's usually equal to the required return that is on the firm's common stock, so RS. So again, Duchess, they have a cost of retained earnings that are equal to the required return on equity. So we used the required return using two methods. With the constant growth, we looked at 13% before accounting for those flotation costs and the underpricing. With the cap M, we looked at 12%. So their finance investments through retained earnings fall somewhere between that 12 and 13%. Both estimates are lower than net cost of new issue of common stock because using retained earnings, the firm's going to avoid those additional costs with issuing new equity. In the US and most other countries, firms rely more heavily on these retained earnings than other financing sources. In 2019, the Federal Reserve conducted a survey of 5,514 small businesses. They found that 77% of companies, the most important source of financing was their retained earnings. Let's look at the weighted average cost of capital now, which is WACC, right? So here in equation 9.8, we can see our weighted average. So we're looking at proportion of long-term debt times the proportion of preferred stock times the proportion of common stock. So we're going to be multiplying all of these together, and each of these WD, WP, and WS, they have to add up to 1.0, right? Because we want 100%. So which percentage of our company is in long-term debt? Which percent is in preferred and which is in common? There are important points. Again, the weights must be non-negative. They have to equal 1.0. They are based on the market value of each capital source as a percentage of the market value of their total capital. We multiply the common stock equity weight, that WS, by either the required return of the firm stock, RS, or the cost of that new common stock, RN. We also have to multiply the firm's cost of debt to capture that tax deduction tied to interest payments, right? So 1 minus T, whatever that tax rate is. So in earlier examples, Duchess, we found that the costs of the various types of capital we have, RD was equal to 4.88%, RP was equal to, we're going to round up to 8.26%, and RS was that 13%. So let's see what their total capital now is, right? So they have a market value of $1 billion. They have outstanding long-term debt, preferred stock, and common stock at 400 million, 100 million, and 500 million. So our weights for those specific costs of capital are going to be as follows. So again, everything is out of that billion. So, if you start out with long-term debt, 400 million divided by 1 billion, you're going to get 40% as the weight. 100 million divided by 1 billion, you're going to see preferred stocks at 10%. And then 500 million divided by a billion, you're going to see 50% in stock equity. So those total up to 100%. Because they have retained earnings available, their cost of common equity is going to be required return on equity, RS, or the cost of retained earnings, RR. So we found the calculation, which we're going to look at here. So again, we look at the cost, we multiply it by the weight, we get the weighted cost. So that's W times R. And then we add everything up, right? So we're going to see the resulting WACC is 9.28. It's a hurdle rate for Dutchess. So that means that they need to accept investment opportunities that promise returns above that 9.28, as long as those investments are not riskier than what they currently are involved in. So the weighted average cost of capital is that 9.28. Investments above that value should be taken. Here are some WACC calculations for other well-known companies. So if we look at like Apple, we looked at this earlier. So anything that they have above 8.1%, that's their WACC, then they should invest in that. Facebook has 9.8%, Amazon has 9.5%. You can see that a lot of these companies have higher, I'm going to say equity percentages, like Apple, Amazon, Facebook, Procter & Gamble, even Johnson & Johnson. So they do have a lot of equity rather than the debt, which helps with their, dividends back to people, investments back into the firm. But again, looking at the riskiness level, you can see that Amazon and Facebook are both at 1.3%. That's looking at their beta, right? So with the beta, we can see that the WACC is increased because they do have a lot more of a risk than Procter & Gamble, General Electric. They've been around for years and years and years. So with the capital structure weights, we look at the market value, right? Weights that use the market values to measure the proportion of each type of capital in that firm's financial structure. When we calculate the WACC, the market value weights should be used rather than their book, which is their accounting, or their par values. We also need to look at target capital structure. So that's the mix of debt and equity financing that a firm's going to desire over the long term. And it should reflect our optimal mix of debt and equity for our firm. The WACC, again, is a hurdle rate that a firm's investments must clear if they want to create value for their investors. So using the WACC in this way, it's appropriate as long as the investment is being held to the standard about being as risky as what we averagely, invest in. So if the investment is riskier than typical, the higher rate that reflects that greater risk is appropriate. If the investment is atypically low risk, then the WACC is inappropriately high hurdle rate and a lower rate is fitting. When considering an acquisition, you want to make sure to use WACC to make sure that it's appropriate for the target that's being acquired. So let's review of this chapter. We understood the cost of capital. That's the minimum rate of return that a firm's going to earn on their investments to increase the firm's value. The weighted average cost of capital is a number that blends that cost of each type of capital that a firm's going to use and establishes that hurdle rate for their investments. Primary sources of capital were debt, preferred stock, common stock, and retained earnings. We looked at before tax cost of long-term debt by using our cost quotations or maybe our calculations. The after-tax cost of debt is the product of the before tax minus the tax rate, right? And the after-tax cost of debt, it's the relevant cost that it takes into account because we're deducting those interest expenses. We looked at the cost of preferred stock and how that's the ratio of preferred stock to the dividend to the firm's net proceeds from the sale of that stock. And then we looked at the required return on the firm stock to be calculated using either the constant growth valuation model or the CAPM. We looked at the cost of retained earnings and how that's equal to the required return on common stock equity. We also looked at an adjustment to that required return on common stock to reflect that underpricing and those flotation costs necessary to find that cost of issuing new common stock. And then finally, we looked at the WACC, right? So the weighted average of the firm's cost of capital, where the weights are based on market values and it's in relative to the total market value for that firm. In some cases, the weights may reflect their target capital structure instead. So that takes up this chapter. If you guys have any questions on WACC, preferred stock, common stock, basically the cost of capital, feel free to hop on one of my office hours or send me an email. I'd be more than happy to help you guys. So I look forward to seeing you guys next week. We start brand new material next week. Thanks, guys. Bye.